Stop wondering what's going on with the banking system because if you look at the details, you will know the truth. And I'm going to show you some pretty amazing information about what's happening with the banking industry clearly panicking behind the scenes. A lot is going on. And of course, when you increase interest rates at a time in which nobody believed what ever happened, you start to run into some serious problems. And I'm going to show you where the cracks have appeared. Does that sound interesting? Let's begin. Here we have it. Hot money is piling up at the banks and is starting to take a toll. Investors scrutinize the cost of surging brokered deposits and FHLB loans as mid-sized banks bear the brunt of higher interest rates. Well, apparently, U.S. banks have found a way to replace some of the hundreds of billions of dollars in deposits that flooded out of their doors earlier this year. You remember that? There was just a massive run to the exits. Well, they had some serious problems, right? To shore up the books after a flurry of withdrawals, mid-sized banks have turned to patchwork and other sources that demand significantly higher interest rates, 5% or more. Regional banks borrowed billions from the Fed, number one. And we saw that where the Federal Reserve set up this temporary thing like they've done so many times before. They set up this thing. And even though the interest rates are much higher, that we saw the banks start going, yeah, we want some of that. We need some of that right now. And it is at approximately the highest it's ever been. They're utilizing this quite a bit. So that's interesting that this is where they have chosen. I guess they trust the Fed above all else. And then we have the Federal Home Loan Bank System. And to an eye-popping degree, leaned on brokered deposits cobbled together by little known intermediaries. Okay, so a lot of stuff is happening and it shows that the credit market, like your access to capital, your access to debt, has been squeezed if you are not on the, like, for instance, residential mortgages and things. Not the case, but when we're talking about the big businesses, corporate debt, as well as, on the commercial real estate side, that has been strangled. Now, that's important. An analysis of quarterly regulatory filings for the 84 biggest banks, commanding more than 80% of the industry's assets, shows not only how much they were borrowing through these channels, but also the toll it was starting to take on some of their earnings. Rising costs threatened to turn the most strained banks upside down, leaving them paying more to amass the cash that they need to then need to learn to lend out. Okay, what I'm saying is that these banks are in a world of hurt. They've been borrowing at a rate they cannot pay back, and they're hoping, all of them hoping, that they need to get into a world where they're cutting interest rates. The Federal Reserve is cutting interest rates so that they can survive. If not, more bank failures are coming. That's what this message is all about. They're borrowing from the FHLB, which is basically like the Great Depression. They set this thing up, and this is not supposed to be used at all in this way. But all these companies like SVB were using it as a loophole to get around all these regulations and things. And it worked very well until it collapsed. Here we have it. Banks step up U.S. property loan tweaks to limit defaults. You can see what's happening. They are concerned. They know what's going on. They are setting up what's called loan loss provisions, and that is putting money aside for a rainy day. Banks are showing a growing willingness to rework the terms of the U.S. commercial real estate loans to prevent defaults, mitigating near-term losses, but also masking the growing stress in some parts of the market. So, yeah, you can put a Band-Aid over it, but are you fixing that problem? Well, no, at this point, they're basically doing whatever they can. They don't have a choice. And this is a very big concern. So, they can as they say right here, lenders are offering borrowers loan extensions and modifications, selling derivatives, oh, that's wonderful, to fixed interest costs, and offering subsidized loans to investors to purchase the defaulted loans. Of course, they're taking this, they're packaging it up, they're repurposing it, and they're selling it off to investors. Hey, we got some bunch of bad debt that's going to give you a higher yield than some of that other stuff. You want it? Some investors will take it. I'm not so sure that's a good investment, but hey, if the Fed will bail them out, maybe, might be all right. But you and I, we are not too big to fail, right? The big companies toughen banking partner screening after the crisis. So they're tightening up in all things. The lending standards, the loan loss provisions are there. They are going step by step, worrying and obviously very concerned about what's happening right now. But the banks overall, they are above the law. We know that to be the case. FDIC scolds banks for manipulating deposit data. So remember, I said at the beginning, billions of dollars were flowing out. Check this out. Lenders lowered their uninsured deposits by nearly $200 billion after bank failures. You see, they just need to get around all of it. They just need to know the loopholes. They've got the lawyers, they've got the accountants, they got the people on the inside. They know how to make it work. When SVB ran into financial trouble, its customers ran for the exits. In the weeks after, dozens of banks tweaked their numbers, just a little tweak, to reduce the portions of their deposits that they said were uninsured. Since Silicon Valley Bank collapse in March, 47 banks reinstated their December 31st uninsured deposit figures downward by a total of $200 billion, according to the Wall Street Journal. At SVB, 88% of deposits were uninsured at the year end. Do you see what's going on here? There are big problems. There are holes. There are gaps in these banks right now. And I've displayed for you just some of those. They're using Depression era loopholes, essentially. They are using this, absolute manipulation in order to do anything they can to grow and to survive. And just like you as an individual, you would do the same thing, except if you get caught, that's a criminal offense. If they get caught, at the very worst, it's a little slap on the wrist. Do you see the difference here? They could do whatever they want. They take the maximum risk. They're too big to fail. They get the bailouts. You do not have this option. And as a result, we've got to be prepared for ourselves, for our families. And that means not taking these excessive risks. That means spreading our money out if you have it in the banking system, which I wouldn't suggest generally. That also means we have to hold real assets and have our money geographically diversified. These are all points that you will hear me reference over and over again because I believe wholeheartedly in them, and I know these to be the truth. And those wealthiest people out there, not the Forbes 500 people, but if you look at the wealthy people, the successful people, they're doing just that. They do just that. So that's what we need to take from this. This was brought to me by one of the individuals in the mentorship group, and I want to bring it to you. American Express exits banking in Mexico, shifts focus to credit card services. So just want to be clear, it's the bank that American Express had. It's not the credit cards. Because they love their credit cards, right? But the bank. So you're seeing this for a company like that. It's unusual, I would say, to just kind of walk out. Okay, right now at this time, SVB's collapsing, bank collapses. And now this one bank is just leaving. Just something interesting I wanted to plant here in this video. Government intervention keeps mortgage defaults at bay at a cost. You can see that the moratoriums have been there. You look at what about the student loans? 44 million people, I believe it is, have student loans. The average payment, $400 a month. They have to start paying that back. They have to start paying this back after this hiatus of 3 years. So now what's going to happen is that they're going to have $400 less to pay. Just like the rent moratoriums, the eviction moratoriums, all these different things that were put in place. The stimulus is gone. Now more payments are coming through. You are looking at a strained economy and banking system that is likely due for more losses. That's an absolute fact. Okay. How the Fed's new instant money program could lead to another regional banking crisis, essentially saying you had to have people line up. Like when there is a bank holiday, when there is a bank crisis, when there's a bank run, you would have the same kind of system where okay, the bank has to shut their doors at some point. People are lining up. Everybody's getting outside. They want to pull cash out. In the case of Greece, people were taking out, I think it was 50 euros a day at most. But if you have an instant payment system, a couple taps on your phone and you get everything out. So they're saying this is a big concern. Well, certainly is, but what are they going to do about it? Are they going to limit your access? They're going to use some artificial intelligence to determine what's happening here, to read what's going on in social media, and then quickly react to that, locking everybody's bank up. Maybe they'll do it based on some false information. They lock you out of your bank. You can't get it when you need it most. Oh, false information. Sorry about that. Let's turn the switch back on. How does that sound? Oh, it's coming. It's coming. Fed bid to hike bank capital slammed by the ex-Vice Chair Quarles. I just thought it was funny because any tightening, any sort of breaks that are being applied to the banking system, there's always going to be some people that are going to say, no, this is a bad thing. You can't have a fractional reserve banking system and have sound money or just sound principles within that fiat system. I mean, it just can't happen. But you got to give something. My goodness. Jamie Dimon warns of much bigger threats than recession, more banking turmoil. I'm just trying to highlight that this is from top to bottom. It's everywhere. It's all over the place. You've got things like Tesla are offering an 84-month loan as interest rates rise. People can't pay that, but let's say their budget is $1,000 a month. Oh, okay, $1,000 a month. We just stretch it out another year. And now we can suddenly pay that $1,000 a month. That's what's going on here. You can see that it is affecting just about everybody. Everybody's dealing with the same things. This is going on the commercial real estate side. You're seeing the cracks in the banking system. You are looking at a bank crisis that is unfolding before our very eyes. I have some points there, but I've also got some other points for you too. Whether it's about real estate, which is what I'm showing up on screen here, or so many other things. In the Discord, that's the place where I'm releasing all kinds of information, and I will add to that. We have well over 800 people right now in there. It's totally free, and we can talk back and forth. It's becoming much more active than it's ever been before. It's so cool. I want to see you there. Are you coming? Make sure you go down there, click that link. It's totally free. Click that link, and I will see you there. When you get in, say hey, and I'll reply to you. I'll see you soon. Take care.